Well, what happened today was absolutely no surprise to almost anyone that's been paying attention to the markets in the last week or 2 weeks. You see, up until the last few days before the Bank of Canada's decision on July 24th, the markets were in nearly 100% consensus, 90% to be specific, that the Bank of Canada was about to reduce interest rates. Now, the only question was, what is the likelihood that they were going to go by 1/4 or 0.5% or even more in some situations? And what is it that they were going to say about the future of rate cuts? Well, we now have that news. With the 1/4% rate drop coming on July 24th, Tiff Macklem has dropped the ball and said we're going down another 1/4 point for a variety of reasons. And in this video, we're going to explore not only what happened, because we all know a 1/4 point rate drop, and we'll talk about what it means, but more specifically, what he said about the economy, what to expect, where the housing market might go, and where some opportunities could be, because there are always opportunities. Welcome back, Alex McFadyen here, and if you haven't already done so, please hit that subscribe button, that like button. We'll get right into the goods. Starting off, the Bank of Canada lowered interest rates. The overnight rate now is at 4.5%, which lowers almost all banks' primes to 6.7%. This is welcome, but little relief for many Canadians who are struggling with the high payments or high interest of variable rates that have basically held the course since the summer of 2023, which marks this point right here, 4.5%. In July of 2024 is the first time that we've come back to that measure for nearly an entire year. Now, 1/4% for some might sound like a lot, depending on where you are, but for others who have been facing the high payments or high interest, this basically feels like a drop in the bucket right now. And the question is really, what are rates going to keep coming back down, and what does that look like? Now, Tiff Macklem came up publicly and spoke this morning regarding what the potential outcomes could be, and he used the word downside quite a bit in his conversations. Now, when he's talking about downside and upside risk and using words like symmetry can seem a little bit confusing and, well, really honestly boring, but there is something to pull from what he had to say here. There's quite a bit to pull if you look into it. First things first, he spoke about downside risk quite significantly a number of times. And what he was referring to were a few key factors. Number one, the reduction in overall economic growth from our country. Where we're seeing that primarily speaking, well, we saw this in the past couple of weeks, is reduced employment, so higher unemployment, overall reduction in the increase of wages, reduced spending, and that was very significant, and overall just a lower productivity as a nation. Now, a large part of the overall inflation bucket that they were looking at is still based on mortgage and shelter costs, so interest and shelter, which is realistically created by Bank of Canada and the government as a whole. And so it's not surprising to suggest that they're looking at the data and thinking it's time to start reducing interest rates. So with the 3-month annualized inflation going down and mortgage and interest costs making up a large portion of that, additionally, interest rates still being exceptionally high compared to the 10-year average, the question mark is, well, how does it affect a homeowner and a potential home buyer? Starting off with a current homeowner who has a variable rate mortgage, again, there are 2 different types of variable rates. The adjustable or floating rate client will be seeing a reduction of approximately $15 per $100,000. That's based on today's rates at prime minus 1% on a 25-year amortization, so your numbers could be different. Or if you are in a fixed payment, you'll see a reduction to your total interest, which therefore reduces the amortization. Or if you've increased your payments, allows you to reduce them based on the reduction of the total interest rate. Looking forward, there is no significant change to the ability for people to borrow more money. And this highlights a key conversation and point that BMO actually came out with on July 23rd. They published an article suggesting that there will be no significant increase to the housing market because borrowing power isn't significantly impacted yet by the Bank of Canada's decision. But it does forget one key point. On the backs of today's news and information, the bond yields are already down 5 basis points. And if things continue in this direction, specifically with the US announcement on their Fed in the end of July, we could see the bond yields continue to go down. This would put downward pressure on fixed rates, which would slightly increase the borrowing power for people looking to buy and get into the marketplace. So while essentially the rate reduction doesn't have a direct impact on the ability to borrow more money, this could impact things as we move forward. Which leads us to a next couple of key points. Looking into the Canadian inflation trends and what's going on, which we discussed, again, we're going to come back to this downside risk conversation. Tiff spoke specifically about lower potential employment, so higher unemployment, lower spending, retail and otherwise, the GDP being lower, and excess supply over and over again. So essentially, Bank of Canada is trying to balance between the economy slowing down and people having less money to reduce the overall cost, yet at the same time not overly stimulate the housing market. And I think that they're aware that by reducing the rates themselves, it doesn't have a direct correlation on people's ability to buy, which means it doesn't necessarily have a direct impact on the housing market, but there is a byproduct, which is the psychological impact of people getting into the marketplace. In fact, recently there was a survey that came out that suggested that 21% of people, this survey was from the beginning of July of 2024, 21% of people were waiting for this particular rate drop to get back into the market, and about 40% of people were waiting for 2 more rate drops, which could happen as early as September or December of 2024. Essentially, this means that although the market will be more highly stimulated, it's likely to continue to be a balanced market in most segments, in some segments being still overpriced, and some segments being a little bit quicker to move, really depending on the nature of where these locations are and these property price points. The truth is, the market itself still needs to find out where the happy place is, because you still have some home sellers thinking that the market is higher or going to be higher than it is today, and you still have some home buyers waiting for the market to crash. There's a happy medium there somewhere, which explains why the market has still been kind of plodding along and hasn't really found a bottom yet. This could be a sign that we have reached some form of an artificial bottom, however, in many markets across the country, as it may stimulate people to get back into the marketplace. Now, looking forward, Tiff Macklem was asked the question, essentially, could we see overnight rate at 3.75% by the end of 2024, which would indicate 3 more potential rate drops before the year closes in 2024. And while he wasn't really willing to answer the question one way or another, he basically said we take every decision a step at a time and look at the data at that particular time. At the same time, he didn't say no. So if the data still continues to come out this negative for the next 3 to 4 rate announcements, it is very possible we could see rates come down as much as 0.5 to 0.75% by the year end 2024, which is very different from the information that we were hearing just a month and a half ago, where there was a lot of negativity about any rate drops happening for the rest of the year. So, where are the opportunities in the marketplace is really what a lot of people are asking the question kind of going forward with this information. If you're a current mortgage holder right now who's in a fixed rate mortgage, you haven't seen a massive impact. But this could mean a couple of things. Number one, banks could soften slightly on their fixed rate mortgages. Not necessarily what's advertised, but their discretionary pricing, working with a broker, can help you access those rates. On the negative side, the banks can change their posted rates, which means the penalties can get substantially larger for the ability to access those rates. This is why it's so key to look at the actual penalty that you could pay when you're picking a mortgage product in the first place. The second item to consider is the possibility of seeing more people look at the renewal options and, while not necessarily get excited, but of course be happier with the potential options available. We could see more people choose floating variable rates, which is where the variable rates can adjust down based on the marketplace. In fact, if rates go down by 0.75% over the course of the rest of this year, that means that rates will have declined by 1.25% since June of 2024, which would result in variable rates in the 5%, in some cases below range, with the potential upside of rates coming down another 1% or more, putting variable rates back in the 4% to 3.75% range within the next year to year and a half. The other facts to look at is if we do see the Bank of Canada continue to lower interest rates as much as that 0.75%, at that point we will start to see an impact to borrowing power, which means we might start to stimulate the housing market. Although it may not stimulate people to the extreme ends it had a few years ago, it will definitely bring interest back into the marketplace. And so that means that people who are in the middle of looking at purchasing or considering purchasing in this type of a climate can benefit from getting in before the market gets busy. Even if house prices don't quote unquote skyrocket, you'll have less competition if you're purchasing in a market like this than if you're purchasing in a market where people are coming back, even if supply is still strong. I'd like to know from you in the comments below. What do you think about today's decision? Will it impact the market? Will the Bank of Canada actually reduce rates again next time around? Let me know what you think.